News Radio 700 WLW.
The other thing that is popping its head today is the Dow. Now, look, you may not invest in the market, but your job most probably is dependent on the market. And the Dow right now is within 100 points of hitting 50,000. It's up almost 1,000 for the day, almost 1,000 up yesterday to today. And right now at 49,902. The S&P up big. NASDAQ up big. And yet a lot of Americans are saying, well, that's wonderful. You know, I'm not in the market. I might have a rather modest 401k. I keep hearing that the economy is doing better. I keep hearing that GDP growth is off the charts, probably would have been somewhere north of 6% had they not had the government shutdown in the fall of this past year. Keep hearing about all of these things, and then I see what happened yesterday. I see where job cuts surged in January. Almost 110,000 jobs were lost in January. Almost 50,000 lost in February. So people are saying to themselves, wait a minute, I see what the market is doing. I see exactly what is happening on Main Street with people losing jobs, not getting jobs. What's going on here? Are we really being told the whole truth? Well, you're never really told the whole truth about anything, but what does it mean when it comes to you and me walking around here in Cincinnati when we see these numbers? Standing by is a man who knows. Dan Varroney is a guy we've had on the show before, and we really like Dan because he can take complex issues and break them down. He is the CEO and founder of Potomac, a strategic planning firm out in the Washington, D.C. area. So, Dan, what do you make of this? I'm just, I'm looking at the Dow today. It's kissing 50,000. It's up almost 1,000 over yesterday. Wall Street's doing well, but Main Street apparently isn't feeling the love. What's going on here? Why the disconnect?
Clearly, there is a disconnect. But before we do that, let's amplify some of the good things that have happened. So the Atlanta and New York Fed's growth forecast for Q4 are at cycle highs of both 5.4% and almost 3%. So I think that's very good news. But I want to give you some context.
Well, what does that mean? What you just said, what does that mean to the average guy walking around on the street?
What that says is it represents the following, that there are investments being made by businesses. And what that means is that improvement shows up first in investment and not paychecks. Mm-hmm. So remember, we said in prior conversations that small businesses represent 99.9% of the companies in the U.S. Right. So small businesses invest before they hire. And the issue is borrowing costs are still high and hiring and wage growth are lagging. Once rates fall, the gap's going to close. So the issue is, to a very large extent, is that the cost of money is too high. So when you look at where we are in the economy, look at us in a 5-year window. So think of mobility meaning that if you're in a job, you could get a new, better paying job because we're in a low fire environment. Look at it from a person trying to buy their first home. Interest rates are too high and you can't reach, or if you're trying to get to a bigger house, the interest rates are making it unaffordable. Mm-hmm. So right now what we have is a situation where the cost of money is high and it's causing things to look and feel worse than they were maybe a year or two ago. The issue is, as a means of comparison, I did a good bit of research last night. I went back to the Reagan administration when President Reagan signed his tax cuts and spending cuts in July of 1981. It took 18 to 24 months. Mm-hmm. So it was 1983 when the economy came booming back. But in that 6 months before, it was appreciably better. But let me give you the distinction and the difference. The Federal Reserve was accommodative and they reduced interest rates. Right now, small businesses are saying we're going to make our bet on buying equipment. We're not going to put a big bet on hiring people because the cost of money is too high. And that's what's going on. People aren't buying houses. People aren't hiring people. That's where we are.
Where are we with Kevin Warsh, who is the new pick to head the Fed. Trump obviously had great problems with Jerome Powell, and it sounds like he wasn't the only one. What about Wash, which you just talked about, coupled with him coming in? That has to be positive as well for the consumer, no?
Oh, it's amazingly positive for the consumer. So when you look at Kevin Warsh, and I've done a bit of research, and I'm about to write an op-ed related to Kevin Warsh. So essentially, what Kevin Warsh is looking to do is to bring the Federal Reserve back to Main Street. So what we mean by that is to bring the cost of money lower for Main Street small businesses and for consumers. He is by far a brilliant pick and someone we should all be excited about. The issue is he's got to be confirmed by the Senate in order to move into that role sometime in May. And we don't know what that looks like yet, but clearly he is considerably different in his policy approach than Jerome Powell. If Kevin Warsh were chair of the Federal Reserve right now, I believe interest rates would be at least 1 full percentage point lower than they are today.
Well, Warsh isn't going to get a single Democrat to vote for him. But hopefully the Republicans hold rank on that. Well, I shouldn't say not a single. You may get Fetterman to break rank and vote. But, yeah, I agree with you. I think Powell had run his course and obviously was out of touch with where the economy was or is at this point. So hopefully this is a different touch and a better touch. Do you put much faith? Go ahead.
I think it is a different touch and a better touch. And what I want to emphasize or re-emphasize is that the right policy decisions and right policy actions have been made by the administration. The 100% expensing for plants and equipment is the right thing. Giving people more money to spend. Remember, people are getting more money in their paychecks. The withholding rates are down. They're going to be getting tax refunds. There's still in excess of $200 billion in investment going back to businesses and consumers. What's missing is the interest rate piece. And the other thing that I want to add to this, and it's imperative that we talk about it, there are two pieces of this. The first is on the regulatory side. The Trump administration has been and remains very aggressive on lowering the cost of regulations. That was $1.4 trillion. They're still unwinding them. The closer we get to that will be as we get to the summer and the end of the year. That's going to bring prices down. Right. The other thing is permitting. Permitting for new gasoline, natural gas fields. That is still a challenge. The Trump administration is very aggressive at attacking that as well. So think of permitting and regulations as an obstacle that is being attacked by the administration. There is the right tax policies in place, the right amount of tax stimulus. Now we need lower interest rates.
Yep, and as you just mentioned, drill, baby, drill.
Absolutely.
Yeah. Dan, it's always great catching up with you. Thanks for your time. We appreciate it. Stay well, okay?
You do the same. Hope we talk again.
We will. Thank you, Dan.